What you're looking at is how most large tech companies are funded in the early years. It's basically a hallway with doors. You have seed, you have Series A, Series B. And notice where the public door appears, it's really at the end. Most people, they don't realize this, but when a company is young and risky, its shares are usually not available to the public. You can't just buy them in your brokerage account. Even like companies such as OpenAI, they are still not available to the public, even though they're pretty well known. Access happens through private deals, private funds, private networks. It's not necessarily evil, but it is structurally gated. And that's where the asymmetry begins. So let's talk about dilution, because it's a big issue actually. Even if you're an accredited investor and you have access to these early stage startups, your investment gets diluted over time. So imagine the company you invest in is a pizza. There are 100 slices. You own 10 slices. That's 10%. Now the company raises more money. To do that, creates 100 new slices. Now there are 200 total slices. You still have 10 slices, but your ownership is now 5%. You didn't sell anything, nothing was taken from you, but your percentage shrank. That's called dilution. And in venture-backed companies, dilution is normal and expected. To beginners, it often feels like money printing, basically in the same way that the Fed or the European Central Bank create more new money. Now look at this log. Venture capital is intentionally illiquid. When investors commit capital to a VC fund, they often lock it up for 7 to 10 years. Sometimes there are exceptions, but this is very often the case. There's no simple sell button. Yes, secondary markets do exist, but they're specialized and often discounted. This illiquidity isn't a bug, it's a feature. It allows patient capital and deep company involvement, but it also means flexibility is limited. You basically can't easily change your mind halfway through. Now zoom into today's AI landscape. Many of the most important AI labs, like OpenAI and Anthropic, are private companies. They are not listed. They are not tradable on public exchanges. So if you're an ordinary investor, you don't just buy shares. You might buy related public companies, but that's indirect exposure. So again, access timing matters. Innovation often sits behind the fence. Now we switch mental models. Bittensor is not a company, it's a protocol, a network. At the base, you have Tau, the core token and coordination layer. On top of that, you have many different subnets, and each subnet is a market focused on a specific task. You can look at subnets as startups. Instead of one company raising capital in rounds, you have multiple open markets competing for attention and allocation. And this already feels structurally different. The core idea behind Bittensor is that it could become the standard place for startups to be launched. Imagine that Bittensor delivers. It becomes widely known in the startup world because it allows startups to get funding in a permissionless manner. Then, at a certain point, you could imagine thousands of different startups competing for tau emissions. Most of them will fail, but some of them will become extremely successful companies. And what's groundbreaking, Bittensor allows everyone with access to tau to invest in these early stage startups without any lockup periods. At any given moment, you can stake or unstake your tau. At this moment, most people don't have access to this. With Bittensor, everyone has. And this is one of the most interesting and probably overlooked features of Bittensor, in my opinion. It is so much more than just a decentralized AI platform. So let's talk about the tokenomics a little bit. Tau is not just a token floating around the ecosystem. It's structurally required. If you want to participate meaningfully in Bittensor, you need Tau. It's a coordination asset. You can't stake without it. It's the settlement layer. So capital enters the ecosystem through Tau. Here's the structural implication. If Bittensor subnets become genuinely useful, if they attract builders, users, capital, or even revenue, participation scales. And if participation scales, demand for Tau scales with it, not just because of narrative, but because of architecture. Now let's add scarcity. Tau has a fixed maximum supply of 21 million. That number does not expand by board decision. It does not expand through emergency issuance. It's encoded. So if you own 210,000 Tau, which is 1% of the total Tau, you know something structurally powerful. You will always own at least 1% of total supply. And I say at least because it takes time for the entire 21 million Tau tokens to be emitted. So at this moment, as we speak, there's about, I believe, 10.5 million Tau tokens in circulation. So if you own 210,000 Tau, you actually own much more than 1% at this point in time. So why does this matter? Well, it matters because no venture round can dilute you. No executive compensation package can inflate supply. And that's radically different from enterprise equity. In venture-backed companies, even very successful ones, ownership percentage tends to shrink over time. In the Bittensor model, supply expansion is predictable and capped. Now, important caveat, scarcity alone does not create value. If subnets fail to produce meaningful utility, Tau does not magically become valuable. Supply constraint shapes expectations. Demand determines outcome. So the key question here is not, is Tau scarce? The key question is, does the ecosystem generate enough real activity to justify demand for the base asset? If it does, Tau functions as coordination capital. If it doesn't, scarcity alone won't save it. So each subnet has a maximum supply of 21 million subnet tokens, like Tau and like Bitcoin. Now compare this to traditional venture equity. In venture-backed companies, dilution is normal. New funding rounds, new share issuance, option pools, convertible notes. If you own 1% of a company today, you can very easily own less tomorrow, even if you never sell. I talked about this earlier. If you own 1% of the total subnet token supply, you can't be diluted. No founder can issue new tokens to themselves, and there's no board vote that increases supply. The supply cap is encoded, just like Tau. New tokens are introduced according to protocol rules, so your percentage ownership can decline gradually as emissions occur, but the dilution is predictable, transparent, and algorithmic. It's not discretionary. Now we arrive at the biggest conceptual question. How should you think about subnet tokens? Are they equity? Are they shares? Are they something else? Well, I would say they are not equity. They do not grant legal ownership of a company. They do not provide cash flow rights. They do not give you board seats. They are much closer to economic exposure within an incentive market. And their long-term value depends on something very simple. Does the subnet create real utility? And does that utility translate into sustained demand for the token? For a subnet to succeed long-term, value must flow back toward the subnet token. But it must happen, because scarcity alone is not enough. A fixed supply does not guarantee success. If the subnet produces no meaningful value whatsoever, the token becomes just another speculative instrument detached from utility, as we see with many crypto tokens, by the way. However, if the subnet produces value, the token becomes a coordination asset within that ecosystem. So the structural difference from venture equity is clear, but the economic question remains the same as in any market. Is the underlying system useful? Because ultimately, utility is what anchors value. So let's zoom out now. Venture capital is closed access, illiquid. There are governance rights, board seats, contracts. Bittensor, on the other hand, is open participation, liquid allocation, token exposure, protocol incentives. VC concentrates power and control. Bittensor distributes participation. One optimizes for structured company building, the other optimizes for open market coordination. So, what is profound here? Well, the profound part is structural. Bittensor turns early experimentation into an open liquid allocation market. Instead of waiting for a private committee to invite you in, you can allocate in real time. It democratizes access to early stage startups to anyone with an internet connection. Just let that sink in. It's really profound. And if it works, it changes how capital finds experiments. The key question is, what is the real value of a subnet token? As I mentioned before, subnets need to drive back value to their subnet token. So if you believe a subnet will become successful, it's reasonable to assume that buying its subnet token is a good way to benefit from its success. So if you believe a subnet will become successful, it is reasonable to think that buying a subnet token is a good way to benefit from its success. However, this is not guaranteed. We are still extremely early, like 1.5 years ago, subnet in their current form didn't even exist. We call this DTAO, meaning basically dynamic tau, meaning that anyone can basically stake and unstake their tau at any given moment. So this is extremely new, and only time will tell if this works or not. But I hope the message is clear. Like, the concept is just, in my opinion, brilliant. It really has the capacity to democratize access to early startups. And this is another way that Bittensor could democratize stuff, because its core mission is democratizing AI, basically, or intelligence even. And this is one of the other, in my opinion, fundamental aspects of Bittensor, which is less known, I would say, than the decentralized AI component of Bittensor. Like, most people know it for that, and I would argue that this is actually, well, not more important, but very important as well.